Welcome back to Money Matters. I'm David Crowell from Mortgage Network, and I'm Emily's associate and partner in this show, Money Matters. I'm doing the second segment of the show today, and I've just had the pleasure of listening to Emily give the first segment of the show, which you just listened to. So I'm going to sort of tap off from there and do my kind of spin on things, which tends to be big picture, national economy, mega events, big chess pieces. And I'm going to take off from Emily's conversation, which is the family conversation over money, and I'm going to put the larger economic issues that are associated with that with my spin on it. The important thing to note is that in my business, I'm a mortgage lender, and my company is Mortgage Network, and we are the #1 mortgage lender in the Low Country. So we see a wide spectrum of folks who come in looking for financing to purchase homes and to refinance their existing homes. We see people in every walk of life, so we really get a very strong sense of what the economic issues are that are facing individuals and families throughout the Low Country. The important first kind of overview is that roughly 70%, 7 out of 10 of folks in the Low Country are, from an overall financial perspective, are living basically paycheck to paycheck. So the entire discussion about funds for investment and for long-term planning really are conversations at this moment in time, really are conversations about roughly 30% of the population. That's the arena in which the whole investment philosophy, long-term planning, brokerage accounts, savings cushions, and so forth plays out. The lower 70% of the population are living paycheck to paycheck, and let me describe in economic terms what that means. When you do a budget and you take the simple one sheet of paper, expenses in one column, income in the other column, and work out your family budget or your individual budget, whichever we're doing, and you total up the known monthly expenses, and then you offset that against your income, or to make it easier, to your take-home pay. The 7 out of 10 of you are literally coming up with very close to a balanced number. In other words, the expenses are more or less being covered by the income in any given month. Now, the critical thing here is that such a budget, when it's meticulously done over a period of time, not just for 1 month or 1 week, usually it's a monthly budget, when that budget is meticulously done for a month, what you will normally see is that folks are managing somehow or other to their take-home pay, to their income. You can't go very far if you don't. In other words, if you go over budget 1 paycheck, 2 paychecks, 3 paychecks, 4 paychecks in a row, you're running a deficit and problems begin to appear. The management technique that most people use is to go over budget for a month, pick up the surplus in a credit card, go under budget for another month, pay a bit off on the credit card, and they sort of, over time, maintain a easy or uneasy balance between expenses and income. What's missing in all budgets of that sort, and this is the longer perspective. If you look at the longer perspective, meaning a 6-month run or a 12-month run of expenses and income, is that there's a mystery section of expenses, an unseen section of expenses, which are the surprises and one-time expenses. Very difficult to budget for them. They are always there, but they're extremely difficult to budget for. And most folks, when they do their budgets, don't include them because you can't see them. You can only see them in retrospect if you look back over a 6-month or back over a year period. What I mean by that is the major repair on an automobile. $700 out of the blue, $300 for tires on the automobile out of the blue, a medical expense that is not covered by medical insurance out of the blue, a emergency that a friend has, which causes you to have to give $200 or $300 or $400 of support to that friend, or an emergency that a family member has that causes you to have to give $400 or $500 or $600 of support to that family member. Those extraordinary expenses, those one-time expenses, are budget killers. If you're operating on a pretty much evens basis, paycheck to paycheck basis. The other sort of extraordinary statistic that exists in our economy, in the low-country economy, is that approximately 50% of individuals and households have a standing balance in accounts of significantly less than $1,000. $500, $400, $600 standing balance. So the ability to withstand a financial shock, a financial surprise, a one-time event, is very much limited. Financial anxiety or financial stress is really something that most households are living with on a daily basis. So I'm not here today to tell you anything that you don't already know. If what I'm saying is initially upsetting to hear, don't let it be upsetting to hear. You already know this. I'm simply saying it out loud. The majority of people who you live and work with are living paycheck to paycheck and have a very limited ability to withstand a financial shock of any kind. This leads to financial behavior which people like Emily, people like myself, when we talk about financial issues, we're prone to giving you financial do's and financial don'ts. But those financial do's and don'ts are somewhat insensitive to the reality of the life that most people are leading. A couple of easy examples. A perfectly obvious financial don't is don't run up your credit cards. Well, that's the only safety valve you have for taking care of surprise expenses. Another financial don't is don't go to ground zero. You really have no opportunity not to go to ground zero if you have a financial emergency. So this is the weight, this is the financial stress that the majority of people in the society are living with. We are right now in a time of economic growth and full employment. That does not mean that life on the ground has gotten significantly easier for the majority of the population. The majority of the population are still struggling to make ends meet. This is a very interesting and difficult situation where we're dealing with it. You can see it talked about daily in our political life. We have elections coming up. Both Republicans and Democrats are talking constantly about this issue because it is the elephant in the room. Housing expense in the low country has risen. The easiest example is rent. Rent has increased over the last 8 years in the low country by approximately 40%. That's compounded, so rent is 40% more today than it was 8 years ago. Healthcare expense has increased approximately 50% over the last 8 years. These are financial realities that offset the fact that we have full employment and we have a growing economy. The growing economy largely benefits people in the top group. It has not yet benefited the 70% of the population who are just getting by. So this is something that very much I'd like to address in future segments of Money Matters, and to talk about what we in the low country can do systematically in our financial lives to address this problem. It's a fascinating and difficult problem, but it's very much worth talking about. So I see it every day. I'm in the mortgage business. I see people's financial lives laid out before me, and I look forward to talking further with you about this anomaly in a healthy economy in which 7 out of 10 people are not seeming to benefit. This is David Crowell from Money Matters, and look forward to talking to you again soon.